Alright, let me be honest with you. Most traders are not losing money because they are bad at trading. They are losing because they looked at the market the wrong way. They are staring at charts, drawing lines, and adding indicators, trying to predict what price will do next. But they never stop and ask, why is price moving in the first place? And that's the gap. Because while retail traders focus on pattern, institutions are focused on data, macro, interest rates, and expectations. They are not guessing, they are positioning. So in this course, I'm going to shift your perspective completely. By the end of this, you won't be just analyzing charts. You'll actually understand how the market works. And once that clicks, trading becomes a completely different game. Welcome. Let's start simple. Because this is where most people get it wrong from day one. There are only two ways to analyze the markets: fundamental analysis and technical analysis. Now, most traders, especially beginners, start with technicals, and that makes sense because it's visual. You can see the charts, the candles, the patterns, support and resistance, RSI, moving averages, and it feels like, okay, I can figure this out. But there is the issue. Technicals only tell you what has already happened. They don't tell you what's coming next. Now, fundamentals. This is where things changed. Fundamentals explain why your currency is strong, why a market is trending, why gold suddenly drops, why the dollar rallies, and the cause behind the move. So think of it like this. Technicals only tell you, here is a good entry. Fundamentals tell you, this is the direction the market wants to go. And when you combine both, that's when trading starts to make sense. That's when you stop forcing trades and start aligning with the market. Now let's get into what actually moves price. Because the market doesn't move randomly, there's always a reason. And most of the time, the reason is economic data. Let's start with inflation. Inflation is simply how fast prices are rising in an economy. Now here's where it gets important. When inflation is high, central banks don't like that. What do? They raise interest rates. And when interest rates go up, the currency becomes more attractive, more money flow into it, and that's where the currency strengthens. So when you see CPI coming out higher than expected, don't just think, oh, inflation is high. Think, rates might stay up for longer. That's bullish for the currency. Now this is the big one. If you understand nothing else in this course, understand this. Interest rates are the number one driver of currencies. Higher interest rates is equals to stronger currency. Lower interest rates is equals to weaker currency. Why? Because money flows where it gets the best return. So if the US has higher rates than euro, investors move money into the dollar. And that's why pairs like euro USD move the way they do. GDP is just economic growth. If an economy is growing, that's positive. If it's slowing down, that's negative. But again, don't look don't look at it in isolation. Always think, how does this affect interest rates? How does this affect expectations? Jobs data is huge because it shows the real economic strength. If people are working, they are spending. If they are not, the economy slows down. So when the NFP or jobless claims comes out, markets react fast because this is the data that tells you what's happening right now. Now this is where things can move aggressively. War, conflict, global tension. These don't just affect one market, they affect everything. For example, when oil goes up, inflation goes up, rate cuts are delayed, the dollar strengthens. Everything is connected. Now, we go deeper. This is where most traders never reach, but this is where the real edge is. Monetary policy is basically how central banks control the economy. They control interest rates, money policy, liquidity, and every decision they make moves the market. You can hear these terms a lot, hawkish and dovish. Let's simplify them. Hawkish means the central bank wants to fight inflation. They raise the interest rates, the currency strengthens. Dovish means the central banks want to stimulate the economy. They lower interest rates, the currency weakens. So when you hear the Fed is hawkish, that's not just news, it's direction. Now let's talk about something most traders ignore, positioning. Because market don't just move based on data, they move based on who is buying and selling. Retail traders are emotional, reactive, and usually late. And most of the time, they are wrong at extremes. So when you see 90% of traders are buying, that's not bullish, that's a warning. Smart money, this is where you want to be aligned. Smart money is institutions, hedge funds, and bank. They move the market, not you. So instead of asking, what are traders doing? Ask, where is the money flowing? Not this one is underrated, but it's powerful. Markets behave differently depending on the time of the year. And this isn't random. It's because of spending cycles, fund flows, investor behavior. So certain months, certain assets perform better. This doesn't guarantee anything, but it gives you an edge. It tells you this is a higher probability period. Now let's simplify everything because this is where people overcomplicate. Here's your framework. Macro buyers. Ask, what is inflation doing? What are interest rates doing? If the economy is strong or weak, that gives you direction. Step 2, sentiment. What is retail doing? What is smart money doing? That gives you confirmation. Seasonality. That gives you context. Technicals. That gives you your entry. And that is the StarEdge model. Most traders think that news is random or manipulated. But let me explain what's really happening. The market is reacting to expectations, not just numbers. The forecast was actual. This is the key. If a number comes out, the market doesn't ask, is this good? It asks, is this better or worse than expected? That's the surprise factor. For example, if NFE is expected as 110,000 and it comes out as 73,000, that's a miss. And the market reacts fast. But if it comes out exactly at 110, nothing really happens because it was already priced in. How institutions trade it. Before the news drops, institutions are already positioned. They've already modeled the outcome. They are not reacting, they are anticipating. You win when they are wrong, because when expectations are wrong, the move is strong. How to trade it? Keep it simple. Focus on major data. Compare forecast versus actual. Look for surprises. Understand the reaction. And this is where StarEdge comes in. Instead of trying to track everything manually, StarEdge organizes it for you. So you can see what matters, what changed, and where the opportunity is. At this point, you'll see the market differently, not as random candles, but as a system driven by data, expectation, and money flow. Most traders will never understand this. They keep chasing signals. But you now understand the game. And once you understand the game, you don't chase the market anymore. You align with it. This is the star edge.